It can seem really overwhelming to know if you're in a position to retire, but it doesn't have to be that way. In today's video, I'm going to share with you 3 numbers to know that will show you if you can retire. Hey everyone, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. The biggest fear people have when it comes to retirement is running out of money. They want to know they're going to be okay. They want to know that they're going to have income to support them and not ultimately turn into a burden on their children or other community members. Now, as you think about this, the list of things you need to get right to retire can seem endless. Whether it's Social Security or income or taxes or investments or all the number of things that you have to get right to make the most of your retirement. There are a lot of details. But in today's video, I want to share with you 3 numbers that if you get these numbers right, and if you know these numbers, it will help you see very clearly if you're in a strong position to retire. Because the approach most people take is they say, how much do you need to retire? Well, someone might throw out there $1 million, or someone might throw out there, well, it's 12 times your annual salary, or someone else might throw out another number. Well, is it possible that there's one number that works for everyone? No. So let's see how these 3 numbers can give you the exact amount that you need in your portfolio to determine that you're ready to retire. Number 1, the first number that you need to determine if you can retire is your expenses. Now, this seems like a daunting task for most people, but let's simplify it. When you look at your expenses, some people, they have the spreadsheet, they have the numbers, they can tell you to the penny exactly how much they spend each month. Most people can't. And if you can't, don't feel like that's a bad thing. Let's look at a much more simple approach. Start with your income today. Chances are good that when you retire, life will look somewhat similar to what it does today. Yes, there's no work, and yes, maybe there's more travel or more other activities, but in general, you probably still have the same food expenses, you probably still have a cell phone, you probably still have the streaming services, you're probably still paying for groceries and gas and electric and trash and all those different things. So let's start with today. Now, when you look at your expenses today, it's not going to be exactly like retirement, but here's a simple way of understanding the difference. What's your take-home income today? So you have your salary, but from your salary, you maybe have 401k contributions, you have taxes, you have payroll taxes. What actually hits your bank account? Let's assume it's a simple number, like $10,000 per month. Okay, does that mean you need to maintain $10,000 per month into retirement? For most people, no. From that $10,000 per month, start to look at some expenses you have that will go away in retirement. A big one might be mortgage. Let's assume that your mortgage payment's $2,500 per month, but of that, $2,000 is principal and interest. Well, when you have your mortgage paid off, let's assume you'll have it paid off by the time you retire, property taxes and insurance will still stay there, but the principal and interest portion will go away. So what that tells you is if $10,000 per month is coming in, you don't need the full $10,000 in retirement, you need $10,000 minus the mortgage payment because that's going to be gone. So far, $10,000 minus $2,000 means $8,000. So $8,000 is what you need to maintain to be able to retire. Well, what about any savings that you're doing? Let's assume that maybe you and a spouse are saving to Roth IRAs, $500 per month each. Well, that's $1,000 combined, and when you're in retirement, you might be doing Roth conversions or other tax strategies, but you're no longer contributing from your own cash flow to that. So for $8,000 after backing out the mortgage, we can also back out $1,000 for savings. So now we're at $7,000. Now those are the expenses we'd back out. If you look at retirement and say, well, James, I want to travel, my first question would be, well, does the $10,000 per month coming in allow you to travel and do the trips you want to take? If your answer is yes, well then great, that's already covered because it's already baked into your budget today. If you say no, I want to spend more, much more than I'm currently spending, well, that would be something that we'd add back in. So if we have our $7,000, maybe we add an extra $1,000 a month for travel or $500 per month for travel. Really, this depends on what your dream of your retirement really looks like. Maybe there's other expenses, other things that you want to do. Really, it's about taking your expenses today, backing out the things that won't be there in retirement. This could be things like life insurance premiums. This could be things like principal and interest on the mortgage, savings, children's costs, tuition, other things like that. Take those out of your monthly expenses, add back in anything extra you'll be doing at retirement, and that's going to give you a really good sense of what your expenses will be. In your expenses, that's the first number that you need to know before you retire. Now, by the way, with those expenses, if you're retiring today or pretty soon, that's pretty accurate. If you're not retiring for a decade or so, we'll run some inflation adjustment on that number. But the second thing we want to look at, the second number that it's crucial that you get right, is your non-portfolio income sources. Retirement's all about cash flow. What are your expenses that you want to maintain, and what are the income sources you have coming in to meet those living expenses? Well, the good news is the income's not just from your portfolio. A lot of people think of retirement and think, oh, Social Security, maybe that's just extra, or pension, that's just extra, but my retirement portfolio, that's where most of my income's coming from. For most people, that's not the case. Social Security or pension or rental income, that can go a very long way for most people in terms of supporting a good chunk of their retirement expenses. So if we go back to our example of saying, okay, we have $7,000 per month of expenses that we somehow need to maintain. If I'm going to retire, I need $7,000 per month to come from somewhere. Well, let's start by understanding how much of that is going to come from other places outside of my portfolio. So add those things up. This could be Social Security, this could be pension, this could be rental income, this could be maybe some part-time work that you'll have even once you're retired. What are those income sources? Because whatever's coming from there doesn't need to come from your portfolio. Let's assume that I look at this for myself, and after taxes, it's about $4,000 per month. Well, what that means is $7,000 per month is my goal. $4,000 has already come from somewhere else. $4,000 is going to cover part of that. The gap is what I need to look at next. And that represents the third number you need to know, which is what's your portfolio goal? Meaning, how much do you need to have in your portfolio to be able to implement this retirement? So by the time you've gotten to this step, you know exactly how much you need from your portfolio. Again, $7,000 per month is our goal. $4,000 is coming in from non-portfolio income sources. That gap there is $3,000 per month or $36,000 per year. In other words, I need a portfolio that can somehow generate $36,000 per year after taxes to fill in that gap, which would allow me to say I can retire because I now have a combined $7,000 per month coming in, which is enough to sustain the level of living expenses I have today. So how do we use that number? How do we use $3,000 per month or $36,000 per year to solve for a portfolio goal? Well, we divide by withdrawal rates. If $36,000 per year is how much you need coming from your portfolio, we need to apply a withdrawal rate to that to understand what's the larger amount that you need to have in your portfolio so that a withdrawal percentage of that equals $36,000 per year. Well, if we use the 4% rule, we divide $36,000 divided by 4%, that would give us $900,000. Meaning if we had $900,000 and we took 4% out per year, that represents $36,000 per year, which is $3,000 per month. Combined with 4,000 non-portfolio income sources, there's our $7,000 per month that we need to survive. Now, one thing that's not included in this is taxes. Now, if you're pulling from a $900,000 Roth IRA, we don't need to factor in taxes. All that's going to be tax-free. But if this is all coming from a 401k or traditional IRA, we need to apply a tax rate. Let's assume your combined tax rate's 25%, just to use a round number. Well, what we'd need to do is we would need to factor that in to say, really, you need $4,000 per month coming from your portfolio, because if 25% of that is withheld for taxes, that's $1,000 that goes to taxes, and $3,000 is the remaining amount. Now, what that does is it changes your portfolio goal. So $900,000 is what you might need if your portfolio is tax-free, so it's a Roth IRA. But if you really need to take $4,000 out per month, that really means $48,000 per year. If we divide that by 4%, it gives us a portfolio value of $1.2 million. So you can start to see here, even the makeup of your portfolio is going to determine how large your portfolio needs to be to fill in that gap between non-portfolio income sources and your desired standard of living. If you've watched other videos I've done, you've no doubt seen me talk about guidance guardrails and other approaches where you can take more than 4% out of your portfolio. What's the magic of that? Well, if you can afford to take more out of your portfolio, it means, number one, either the same portfolio value can go much further in terms of how much income it can support, or number two, you don't have to save up as much to still be able to retire and generate the same levels of income. So I'm just using 4% because it's a commonly well-known number, but the reality is you can probably do better if you apply certain principles to your portfolio. So at the end of the day, when you're asking yourself, how much money do I need to retire? Don't rely on an arbitrary number. Don't just look for that $1 million portfolio. Don't just look for some rule of thumb that's thrown out there. Know your numbers. It can be as simple as understanding these three things. What are your retirement expenses? How much of those expenses will be covered by non-portfolio income? Then how do you work backwards to understanding how large your portfolio needs to be to supplement the gap between non-portfolio income and your desired living expenses? If you can get these numbers right, you can have confidence that you can retire, not have to be a burden on your children, know that you're going to be okay, and truly have the peace of mind to actually enjoy your retirement. Now, as I mentioned, a big part of this planning is understanding how can you maximize those retirement withdrawals. If you want to understand more about the framework that needs to be applied to maximize those withdrawals, be sure to check out this video above. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.